Good morning, everyone. Welcome to this week's Main Management Weekly Market Note. I'm James Maxwell, Director of Research here at Main, joined with
Alex Dippery, Research Analyst here at Main.
Great. We'll go ahead and get started. And Varner's on the road this week, which is why we have Dippery filling in for him. Just on our offerings real quick, the normal kind of offerings there. Please reach out if there's any questions or anything of interest. The performance for the trailing week. On the sector side of things, starting out, you had tech continuing to exert its dominance, up 7% for the week. That was actually led by a mix of software and semiconductors for the first time in quite a while. You're seeing those software names start to hook back up. I think it's the third or fourth week here where they're positive. On the indexes side, you've had EM, Nasdaq 100, and small cap all leading. Very much a risk on type of move over the trailing week. That was off of some of the war tensions, looking like a ceasefire is continuing to or head towards that. Not exactly clear, what that's going to look like over the next few weeks. You've kind of had this on again, off again, choppy resolution towards a ceasefire. But nevertheless, equities are climbing that wall of worry, is kind of our perspective. And then relatedly, because of this kind of rumors of a ceasefire or near ceasefire, energy and the broader kind of commodity structure was down, 5% roughly for the week. Recession dashboard, the only thing that remains red on this side is inflation, and we'll kind of get into that here. That's actually a good transition. You got core PCE, which is the Fed's preferred inflation measure that they look at, and you've kind of seen that solid blue line on the left continuing to move up here over the past kind of 6 months or so. Even though that core PCE does not include energy prices, those higher oil prices and higher energy prices feed through to other things like agricultural, fertilizers, things along those lines, food, etc. So that's continued to kind of have pressure on the Fed and making it front of mind for the Fed. We'll see kind of how it impacts any potential cuts or hikes. I think we'll kind of get into that, but on the high level, continuing to move up, it was up 0.24% month over month in April, below forecast, but still year over year is up around 3.3%, which is the highest since November of 2023. On this report as well, we also got income and spending. On the spending side, it was up 0.5% month over month, which is an upward revision. Sorry, March also got an upward revision to 0.98. And overall, you've seen kind of spending be solid. Part of that's also due to the inflation effects where it's a nominal figure. But even if you look kind of adjusted for inflation, spending's still been positive. It's been solid overall. So the kind of inflation side of things hasn't stamped out the consumer spending from that standpoint.
Yeah, it's very clear that the inflation side has become the priority as far as the dual mandate. The Fed's starting to turn a little bit more hawkish. Even if you look over the course of May, rate expectations at the start of May, you had about an 80% chance of a pause, nothing, and a 20% chance of some sort of cut. You're now at a point where it's roughly 50-50. And this is for the end of the year, for December, of a pause versus one hike by the end of the year. So just over the course of May, you've seen the odds there swing pretty dramatically towards the potential for rate hikes.
It does feel kind of weird to me because it's very unusual to see like one hike in any sort of cycle.
Definitely.
Obviously, you've been in a cutting cycle here for the past 2 or 3 years, and the pressure has been definitely on the downside. We've had the spike in inflation. Is the Fed going to react and just hike rates one time? That seems unlikely. If they are going to hike, they'd probably have to undo basically all of those cuts that they've done over the past 12 months, which would be at least 75 basis points. So three hikes. That seems unlikely at this point that they would do something so drastic. I think some of the language from some of the Fed has kind of stepped off of that. In terms of hikes, inflation, something like this from a temporary spike in oil prices is something that's less, you're supposed to be less reactive to, but we've seen in 2022 was a good example, like that had oil prices spike up and also downstream effects as well, that lasted for years.
Yeah, I think it's a good point that your outcomes are probably fairly bimodal.
Mm-hmm.
I mean, even if, you have a forecast of, 0 to 1 hikes right now,
Yep.
it's obviously an average. And so more realistically, either you see a prolonged war, excuse me, heightened inflation for longer, more
Yep.
inflationary pressures that start to be less transitory,
Mm-hmm.
and like you said, be 3 or
Mm-hmm.
even more hikes, or you see a resolution to the war, oil come in,
Yep.
less persistent inflation, and you probably don't need to hike at all.
Yeah. I think our base case, to be clear, is not that they'll hike. I think it's kind of the thought experiment of if they do hike, the the trend or what typically happens would mean that there are more hikes. But I think
Yeah,
our base case is that they don't hike at all or even cut over the next 12 18 months.
definitely.
On to the rest of that income and savings report. Incomes were flat month over month. That was disappointing relative to forecasts for a 0.4% rise. There were some kind of idiosyncrasies in there with Farmer Bridge Assistant Program closing during April, but even still, kind of over the longer term trend, incomes have been trending lower. They're up just 2.5% month over month. Because the incomes have been trending down and spending's kind of been solid, you've seen the savings rate, which is basically the residual of those, declining. That's now down 2.6%, the lowest since June 2022. There's some interesting kind of artifacts in that savings rate. It's something that people look at as an example of like how stretched the consumer is, basically what percentage of their incomes are going towards savings rather than spending. And there are some kind of weird parts of it. We've looked into the fact that a lot of the baby boomers are retired, obviously don't have the same level of income that they once did. They're spending kind of well within their means, but that is showing up in things like services, going on cruises, hotels, experiences, whatever else. You're also having some amount of wealth effects there, where
Yep.
obviously equity markets and just broader markets are near all time highs. People's savings, if they have 401k or some savings in the stock market, those are at all time highs. They're able to maybe use some of those to supplement their income. So there's kind of these other effects that maybe suggest that it's not as negative as it appears on the headline, but worth keeping an eye on.
Yeah, I think this is one of those indicators that, as you mentioned, has some more, call it mechanical
Yep.
distortions right
Yep.
now. I mean, even, on the baby boomer side, more than half the wealth in the US is held by baby boomers. I think
Yeah.
it's 51% to be precise.
Hmm.
And so, if you have all of that portion of the economy that is either retiring or soon to be retiring, you're going to get some pretty big distortions with a metric like this.
Yep. Exactly. We also got the second estimate for Q1 GDP. That was revised down to 1.62% quarter over quarter. That was down from the original estimate of around 2%, primarily just revisions down in consumer spending. This is obviously looking at Q1, which is now 2 months behind us, or even more than 2 months, if depending on where you're looking in the quarter. So certainly lagging relative to some of the more timely data points. But the kind of overall takeaway I would point out is the private domestic investment on the right side there and the yellow chart was revised down, but also still up. Around 7% quarter over quarter. You had within that business investment in equipment jumping 17%. Very much this kind of ongoing cyclical build out. Some of that tied to the AI data center build out. Some of it more broadly to just cyclical build out of infrastructure. But that's kind of the high level takeaways. Nothing too concerning here. Obviously, a little delayed in this data, but still kind of remaining at a solid, steady pace. We also, within that report, got the Q1 spending and inflation. I mentioned it earlier, but consumer spending was revised down. That drove the overall number down. And then on the inflation side, kind of telling us the same story, which we've already gotten in the monthly data, hotter than kind of wanted or expected inflation. But again, this is a quarterly data point. We're looking at monthly or even week to week, so a little bit of outdated reporting here, just from the nature of how these things get reported. On durable goods, this was a pretty big report. It jumped around 8% month over month over April. In April, a huge increase in non-defense aircrafts and parts at 166%, the largest monthly figure since May of 2025. A lot of that was also driven by goods ex transports, up 1.1%. That's the 13th month in a row that it's been up. And overall, I think if you're looking at the year over year, you're now the total durable goods orders are up 17% over the past year, the highest since May of 2025. Very much a pro-cyclical. I keep kind of coming back to this, like infrastructure build out, all of these things that are driving these durable goods orders.
Yeah, as James mentioned, this is generally thought to be a pretty strong leading indicator for industrial activity, increased manufacturing. That's a trend that, we've brought up a lot. We've
Yeah.
largely positioned our strategies for. Even at the time of this recording, we saw PMI this morning. Those numbers were very strong as well. And so we've seen this broader trend towards industrialization, a push towards manufacturing. That's something we expect to continue to see and that, we're actively positioning for.
Yeah, that also ties into the goods trade balance, where this is for April. It was both imports and exports posted solid gains. Exports are now actually at an new all-time high, and then imports are at their highest levels since last year's tariff episode. It's kind of a funny result if you think about part of the reason why the tariffs were put on or were kind of pushed for was to push domestic exports, and that's obviously now they're at an all-time high. That helps things, and within the categories, one other thing I'll mention: capital goods ex autos are up 40% year over year. That is a massive increase. A lot of that within that is sort of this AI trade, the trade of semiconductors, broader kind of wiring, chips, infrastructure, all of that kind of tied to the data center build out. Again, these hyperscalers, your Meta, Google, Microsoft, et cetera, are spending $800 billion a year over the next few years. That's kind of the expected amount of CapEx. That's going to be showing up in some of these economic data points. That's that scale in which like the actual, real economy is getting impacted.
Yeah.
So that's that for this week. Just as a recap, the April core PCE number came out around 3.3% year over year, which is the highest reading since November of 2023. Within that, spending remains solid. Nothing too concerning there, but incomes were flat. So as a result, the kind of residual savings rate declined. But also, we'll mention that there's some artifacts in there with baby boomer retirements and other sort of effects. We also got the estimate for GDP. That was revised down slightly based off of consumer spending, revising lower, but private domestic investment continues to hold that number up. Durable goods orders jumped, again, based off of kind of broader cyclical infrastructure build out. And then finally, the goods trade balance came in a bit narrower than expected, but both imports and exports continued to increase. For this week, Dippery mentioned it earlier, but we got manufacturing PMIs today. We have JOLTS on Tuesday, tomorrow, followed by ADP payrolls, service and composite PMIs, Q1 productivity and job cut announcements. And then on Friday, probably the biggest report of the week will be the non-farm payrolls, so the monthly jobs report. And we'll see how the labor market's been holding up. I think that's all for this week, and we'll see you all next week. Take care.